Once again, we are witnessing a difficult environment for interest rate markets. 30-year US Treasury yields are back above 5%. So the obvious question is, what is driving this latest increase? The first explanation that comes to mind is inflation. Trade tensions around the Strait of Hormuz could push price higher once again, but the market data tells a slightly different story. As you can see in this chart, 30-year break-even inflation, which reflects the market expectations for future inflation, is not particularly elevated by historical standards. In fact, it has been moving lower in recent months rather than higher. For bond markets, the driver behind the recent moves has been the real interest rate. 30-year US real yields are now approaching 3%, a level that has been reached only in a single occasion. That exception was at the end of 2008 and the beginning of 2009 during the global financial crisis. At that time, the increase was largely caused by forced selling and deleveraging across the hedge fund community, rather than by a normal economic adjustment. So why are real yields so high today? One reason is certainly the sharp increase in government borrowing. The supply of government bonds has grown substantially in recent years, particularly in the United States, but also in Europe. More bonds need to be absorbed by investors, and that additional supply is putting upward pressures on yield. But there has also been another new important development over the past 6 months: the rapid growth in bond issuance from the large technology companies or hyperscalers. The development of artificial intelligence requires enormous investments. Companies need data centers, semiconductors, power generation, and network infrastructure. All of this is extremely capital intensive. As a result, the hyperscalers are issuing hundreds of billions of dollars of new corporate debt. And that debt is now competing directly with government bonds for investors' capital. As you can see from this chart, credit default swaps for the hyperscalers have been moving higher. That doesn't mean the market expects these companies to default. They remain among the strongest and most profitable companies in the global economy. Instead, wider spreads reflect concern about the amount of debt that these companies may need to issue in the coming years. And when investors expect more long-dated corporate bond supply, it is not surprising to see upward pressure on the long-term government yields as well. So, what does this mean for corporate bond investors? As the final chart shows, credit spreads remain relatively tight compared with historical levels. At current valuations, neither investment-grade corporate bonds nor high-yield bonds offer a particularly attractive balance between risk and return. For this reason, we believe investors should remain relatively conservative in their credit allocation and favor higher quality issuers. The area where supply and demand still look more supportive is the banking sector. Bank bond issuance is relatively stable and in some part of the market could even decline. That creates a very different technical picture from industrial corporate bonds. In industrial credit, largely because of hyperscalers borrowing, total issuance could increase by 25 to 30% over the next few years. So the message is relatively simple. Long-term yields are rising mainly because of higher real rates rather than higher inflation expectations. Government borrowing remains heavy, while artificial intelligence investment is creating a new and powerful source of corporate bond supply. With credit spreads already tight, this is a market where selectivity matters. We continue to prefer higher quality credit with a particular focus on financial bonds. Thank you for listening and see you next time with Bonds in a Blink.